and you have to accept that, okay, when we record. And we are going to go ahead, and you should be able to see the PDF for chapter 1, and this was posted under the chapter 1 module. And so you should really print off at this point or have available on your tablet up to module 5 at least, because I don't, we won't get past module 5, but we may get into module 5, because what I'm going to be doing is I'm going to be marking up and highlighting the text as we go along. I'm going to be talking to you about particular material that I think you should flashcard and whatnot. And so it is important that you're marking up the book as you go along, so you remember any comments I made, any calculations that I might have shown you as to how to answer a question, because we will have class questions that we'll go through together, flashcard indications, etc. So it is important that you have the information for the textbook in front of you in some form, hard copy. Okay, sometimes I just print them out, or I have the book hard copy, or on a tablet where you can mark up with me as you go along. Okay, now as you can see, I have a palette of colors over here. Sometimes I'll change colors just because we may be in a particular paragraph and they'll say these are the rules except for, and I may use yellow for the rule and blue for the except for, just to contrast the difference. I don't know that you always have to change colors along with me as you're marking up. If you want to do that and that helps you, that's fine. That is not necessary. I just do that to bring your eye to maybe a contrast in a set of paragraph information, etc. Okay. So what we're going to do is start with the chapter 1 table of contents. And what I do here is I give you a general idea as to how heavy a particular part of the material for the chapter is going to be on your exam. Okay. So when we deal with standards and the conceptual framework, and we'll spend a little bit of time with that here at the beginning, that tends to be a fairly light area, maybe about 2 points on your exam. Don't expect a lot of multiple choice questions in that area. We'll deal with the income statement. Notice I'm just changing color here because we've changed thought from standards to income statement. And when we get to the income statement, that tends to be about 5 points on the exam. And what we're really talking about is the form and content of the income statement. How do we display information on, for example, a multiple step income statement? Balance sheet is kind of silly that they even mention it here. There's no point value there. They're just reminding you that there's such thing as a balance sheet. And we're really going to cover balance sheet issues much more after we get done with chapter 2. We'll really start focusing on balance sheet accounts, and we'll literally work our way down from cash to receivables. Chapter 4, we start getting into inventory and so on. Okay, liabilities start coming up in chapter 5. So we'll spend quite a bit of time with the balance sheet as we move forward. Revenue recognition, okay, it's probably the big point area in this chapter. This is a 10-point area. And I'm hoping that we can cover both modules related to revenue recognition. I've combined those here into 1 point value here, 10 points. Okay. Income from discontinued operations, maybe about 5 points. They really have de-emphasized that these days. Accounting for changes and error correction, you can expect 10 points there. The examiners like to ask questions there. Statement of comprehensive income and the concept of comprehensive income, about 5 points. Adjusting journal entries, about 5 points. I would almost think that to be part and parcel to the solution to error correction. Okay, when financial statements are sick, they have errors. Those errors are corrected with journal entries, adjusting journal entries. And so we'll spend a little bit of time at the end looking at that. Now, sometimes I'll get students and they'll say, oh, I see, John, so you only want us to study the 10-point areas, and that's not correct. When I put down 10 points, that means you absolutely have to know that area cold. We're going to have a lot of flashcards. You can expect to see task-based simulation in your homework. You can expect to see multiple choice questions on the exam. You can expect to see task-based simulation that may cover the entire task-based simulation, may cover revenue recognition. When we start getting into some of these 5-point areas, you'll probably see a sprinkling of multiple choice questions, and you might see a piece of a task-based simulation, one of the testlets that deal with that material. So you have to basically know everything. There is no excuse for not studying anything, or there's no magic formula. Sometimes I'll get students say, I'm running out of time before my exam. What areas can I skip? And my answer is always none of it. The one thing you don't study is the thing that will be on your exam. That's the rule. Okay, so you need to look at all of this, but I think it's worthwhile for you to get some kind of sense as to the relative point values of these different areas. Okay. All right, good. So with that, let's go ahead and let's start to take a look at module 1, which is fairly light. Okay. And let's just start to understand who sets the standards that accountants are to follow when they prepare financial statements. If we're CPA auditors, we'll be looking to see that our clients have followed these standards when they prepare their financial statements. So it is worthwhile knowing who sets the standards, and we really focus on US GAAP on the CPA exam. It used to be here a while back that the examiners are a little fickle these days. They're a little trendy these days. For a while, they wanted to have IFRS on the exam because they thought that the US was going to go over to IFRS. The US did not. And many CPA firms really don't have clients that use International Financial Reporting Standards. So it is no longer tested on the CPA exam. IFRS has been eliminated from the CPA exam. So we're really focusing on the US standard, US GAAP on the financial exam. Now, this section here could almost read more like a history lesson than an accounting discussion, and that after the crash of the stock market in 1929, right, almost 100 years ago now, guys, what happens? The 1933-34 Securities Acts were passed, and the 34 Security Acts created the Security Exchange Commission. And in that act, it was stated that the Security Exchange Commission has the legal authority to set accounting standards for all public companies. And they basically employed interstate commerce to say, hey, if you're trading stock across state lines, the federal government can regulate you, and that will be the responsibility of the Security Exchange Commission, and they will be responsible for setting standards. Now, what we're going to see is that the SEC in its infancy, I don't know how to say infancy, okay? So when it was baby, okay, it went and it turned its standard setting authority over to the private sector. And then there have been a series of private sector entities that set the accounting standards, and they are recognized by the SEC. But the SEC has the legal authority to set accounting standards, and they continue to weigh in to a certain extent with various publications to this date. So the SEC, even though it has the legal authority, has delegated that to various entities, and they still, however, issue public company specific rules that you can see listed here. These are still things that are promulgated by the SEC and would have to be followed by public companies, even though the bulk of the standard setting has been delegated to the public sector. Okay, so SEC has the legal authority, but then they have gone ahead and done what? Taken that legal authority and delegated it to the private sector. Okay, so it is delegated. That says delegated. By the way, guys, I never had good handwriting. I've never had nice writing. I don't like send cards or notes to anybody because I'm afraid they'll think I'm trying to, scare them or something. Okay, with my handwriting, it's awful. It's scary. Okay, so don't think that you will be able to read my writing off of the screen. So what I will do is follow the verbal, the audio clue. I will say what I am writing and I will repeat it, okay? So the SEC has delegated its authority to the private sector, okay? And over the years, those organizations have changed, okay? So they started with the Committee on Accounting Procedures, and they issued accounting research bulletins from 1939 to 1959, and they were part of the American Institute of Certified Public Accountants, the AICPA, the same people that write the auditing standards, that write your exam, for some time set the accounting standards, okay? Once again, in 1959, they disbanded the CAP and they created the Accounting Principles Board, once again in the AICPA, and they issued Accounting Principle Board opinions, and that constituted gap from 59 to 73. Now, what happens is when they disband one of these private sector standard setting bodies, they don't just blow up everything they did before and start over again. The new standard setting body will adopt what was already in place and then make changes as they go along. So from 39 to 73, you have what? Accounting research bulletins, you have accounting principle board opinions, and you still had the SEC weighing in for smaller, more granular or specific regulatory issues that they wanted to assert on public companies setting the accounting standards. Then in 1972, there was a committee called the Wheat Committee. Wheat was the chairman's name. And what the Wheat Committee said is, look, we perceive a problem here. There's a lack of independence in the standard setting process. What happens? CPAs pay their dues to be a member of the AICPA. But where do CPAs get their money? CPAs get their money from their clients. So what's happening? The AICPA gets its money from CPAs, the CPAs get their money from the clients, the inmates are running the asylum. What we need is a separately funded, independent accounting standard setter. That organization shall be called the Financial Accounting Standards Board, and it shall get its funding through something called the Financial Accounting Foundation. Now, it was a little bit of form over substance for a while, and that the Financial Accounting Foundation was getting its funding from the companies. So it was a little bit silly in that, if I'm the CFO of General Electric, I've got something to say about, what happens with the accounting standard setting process, even though we set up this Financial Accounting Foundation and the foundation was funded by FASB. But what happened with Sarbanes-Oxley is Sarbanes-Oxley came down and said, if you're a public company, you got to pay to play. We're going to make you pay a fee. That fee will fund the FAF, and then the FAF will fund the FASB, okay? So the current standard setter, as I'm sure you're aware, okay, current standard setter, and they've been in place since 1973, is the Financial Accounting Standards Board, okay? And it's a full-time board. The other boards, by the way, were part-time. That was the other thing. You spend some of your time working for a CPA firm and you spend some of your time setting accounting standards. No. In 1973, they established a full-time standard setting body. It's a 7-member board. They make about $500,000 a year or so. They meet in Connecticut, nice part of the country and that sort of thing. And, they set the accounting standards. And when they do, they issue standards that you see listed here, statements on financial accounting standards, interpretations, technical bulletins, emerging task force information, etc. Okay, and it's a 7-member board. They serve 5-year terms, and they may be reappointed, so they hang around for basically about 10 years. Now, if you look at this, you can see that this might get a little confusing for a company. Geez, I'm trying to prepare my financial statements, and I've got some Accounting research bulletins still in place. I have some APBO opinions still sitting there, or APB opinions. APBO opinion is redundant. I got interpretations. I got the SEC. Now I got the FASB. And it got a little overwhelming. So what they did in 2009 is they created a codification. And the codification is basically organized by topic. And if you are interested in looking up an issue for a particular topic, say the statement of cash flows, you just go to the accounting standards codification and it's in topic 2.0. Isn't that funny? You can prepare for all kinds of things and you think you got something in your head and then you realize it's not there. I think it's in topic 203. Oh, it's 230, 230. There it is. 230. You sit here and I read this and I know what I want to say about something and you think it's in your head and then it's not there. Topic 230, okay? And if you want to know something about the statement of cash flows, anything that is said in any one of these pronouncements that we have highlighted up here will be in that section. So it eases the research of particular areas. So we have the accounting standards codification has been in place as the single source for US GAAP, and it constitutes the informations that are used to set the accounting standards. Okay. Okay, good. Practices not including the codification are not GAAP. Okay, now, where does this become particularly important for you, this whole little story? When you do your research. Okay, so what's going to happen? On every exam, you will have at least one research task that you will have to do as part of your task-based simulation. And what they're going to ask you to do is do a keyword search on whatever the topic is, and then you're going to have to answer your question, and you're going to have to provide them what is the topic, okay, what is the section, okay, what is the paragraph, that particular answer was provided. Okay, so you literally would have to say that, hey, the topic was actually section 230 if it was statement of cash flows, and the answer was found in paragraph 10, which is overall. And then they often will ask for a actually they ask for a subsection here, which would be 10. Then they'll ask for a paragraph citing. Okay, you'll have to give them which paragraph. I don't know, I'm just making that up. 3. So you'll have to code your answer like this. Okay, so it is important that when you're doing your homework and you're doing your task-based simulation questions, you will almost always in every chapter see at least one research, and you need to practice using the software, doing the keyword, and seeing that you are able to find what section of the codification would answer whatever the question is that's being asked. And you know, that's going to be on every exam. You can count on every exam you have at least one research. Sometimes I hear that there are 2 research questions. Students will, although no student is supposed to tell me what was on their exam, sometimes I have a dream that students violate that rule and tell me that they had 2 research questions on your exam. Okay, so you need to be ready to practice with that. Any question? Okay, only deals with US GAAP, guys. When we get into Governmental Accounting Standards Board, there is no information codification on governmental accounting standards. So even though the FAF is over both the FASB and the GASB, okay, they provide funding for both the FASB and the GASB. Only the FASB stuff sits in the codification. Okay, now a while back the FAF created also a private company council. And what they're basically trying to do is see if they can help to set some guidance for private companies. But basically, the exam really does not get as much into the private information. But if you did see something like that, private companies are incorporated into relevant sections of the accounting standards codification if they have sort of a rule that's a little less complex. For private companies, FASB will mention that. The examiners don't get too far off into that, though. Okay, good. So we only have to worry about US GAAP. We don't have to worry about international standards anymore. And so let's just go ahead now and start to understand this conceptual framework. Okay, now, one of the criticisms that was made of the predecessors to the FASB, the ARB, the Accounting Principles Board, is that they, in the WEEC committee report, they said, you know, they tend to go from subject to subject, and there's no underpinning, there's no conceptual framework as to where they're going when they set the accounting standards. So one of the recommendations of the WEEC committee was, hey, establish the FASB. And another one was that the FASB be the one that sets up a conceptual framework that give us the underpinnings, the whys and wherefores for the standards. So what these conceptual framework do is they are not GAAP, but they explain reasoning behind standards. So they in and of themselves do not establish GAAP, but they do what? They explain the reasoning behind the various standards that the FASB comes out with. Okay, so let's just take a look at that. The FASB has created a conceptual framework set forth in pronouncements called Statements on Financial Accounting Concepts. Okay, they serve as the basis for all FASB pronouncements, but they are not GAAP, but provide a basis for the financial accounting concepts that businesses are to use. Okay, so again, they are not GAAP, but they explain the reasoning behind the standards. So why don't you go ahead and flashcard that in case a stupid CPA exam question tries to trick you into thinking that you know, the concept statements are themselves GAAP. No, they explain the reasoning behind GAAP. So when I put FC like that, guys, that's indicating to you that I want a flashcard. So what you should do is you should put a quick question on the blank side of a card. Now, maybe in the predetermined flashcards that Becker has provided you as part of your course materials here, that flashcard is already there. You don't have to remake it. But if you don't see one there, what you would do is you would say, are financial accounting concepts GAAP? You might put that on the blank side. Flip it over, and you would say, no, they are not GAAP. Instead, they serve as the basis for all FASB pronouncements, something like that. And now you have that concept on your flashcard. And then before you do your homework, before you actually do the multiple choice questions, you'll make the cards, you'll memorize the cards, and you're going to find that when you get into the multiple choice questions, you're going to be scoring pretty high because you already have the key concepts memorized, as we talked about how to study file, which is still there, guys. If you haven't printed that and taken a look at that, take some time to print that how to study file and take a look at it and try those methods that I talk about in there. Those methods are, you know, I've got a lot of students that have passed the CPA exam. I've been doing this for 30 years. I probably have, you know, in the thousands of students that have passed the exam using those methods. Okay, so make sure you're taking a look at that and using that as you go through your homework, starting with this first chapter. Okay, so when we look at the concept statements, basically the latest one is sort of the omnibus one. I don't know if it's the latest, but the omnibus one is the statement number 8. Okay, so we're going to really focus on statement 8, and we're going to look at various chapters of statement 8. And when we look at statement 8, the FASB tells us that we are preparing financial statements for primary users. Our primary users are investors and creditors. So when FASB sits down and they're considering a standard, they're not thinking about their mother, their brother, unless their mother and brother so happen to be what? Investors and creditors, then that's who they're thinking about. They're thinking about investors and creditors. Now, they put a little bit of responsibility on the shoulders of investors and creditors, say they should be reasonably informed and whatnot. But they are the ones that the FASB is thinking about when they prepare a set of financial statements. So when they issue, I should say, a standard that'll instruct companies how to issue and what to put into their financial statements, they're thinking about these primary users, investors, and creditors. Now, there are other parties, including regulators, the SEC, the IRS, the general public, who are also interested in financial statements, but they are not considered primary users. So they would be considered secondary. That says secondary users. Secondary users, okay, FASB, doesn't want to disrespect them and say we don't care about you, but you're not our primary focus. You would be our secondary, such as the SEC, the IRS, right? They would be interested in the financial statements of entities, but they are not the ones that the FASB considers primary users. Okay, so we have our users, and now we want to provide them information. So when you start getting into chapter 3 of concept statement number 8, and by the way, guys, you don't have to know the chapter numbers or anything like that, but in chapter 3, they start talking about the characteristics of information that will help these users to make their investment and credit decisions. And so we have fundamental characteristics, and then we're going to look later and we're going to see that there are also enhancing qualitative characteristics, but the fundamental ones are relevance, faithful representation. Okay, so we have faithful representation and we have relevance. Okay, now relevance means that it will be useful in making a decision. Okay, so in order for information to be useful in making a decision, it should have some predictive value. It should have some confirmatory value. Okay, predict what's going to happen, but confirm what we thought was going to happen. And it should be material. Now, material means that what? If the information was omitted, it could affect the decisions that are made by our users of our financial statements. Now, when we look at materiality, we are used to thinking of it, I think, in quantitative terms, right? If I had known the financial statements were misstated by $25 million, right, big number, it would have changed my decision. I would have never bought the stock. But it could also constitute a qualitative issue. If I had known the financial statements were misstated by $25,000 because of management fraud, number has come down, but now we brought in a qualitative issue, management fraud, I would have never bought the stock. So both quantitative and qualitative issues. And so even though they have not come up with a uniform threshold for materiality, it would basically be some set of information, some fact that would change the decision to invest in a stock or to lend credit to an entity. Okay. Now, faithful representation says that the information be complete, neutral, and free from error. Okay. So I kind of think of, like a product that makes you feel completely natural and free, right? You can think about that. I want to be completely natural and free, okay? And so what happens? Complete information means that you aren't leaving anything out. A good example of completeness, let's say, and I don't know what's a good example, a silly example is probably a better word for it. Let's say you are sitting there and your significant other comes home at 2 a.m. and you say, "Where were you?" And the person says, "Oh, I worked late." And you say, "Oh, okay." Now, did they give you complete information? Well, let's say that they were supposed to get off at 5. They worked to 5:15, and at 5:15 they ran into somebody in the elevator leaving, and they wandered off to the bar, and that's the reason they stayed out until 2 a.m. or whatever I said. Well, they didn't give you complete information, right? Okay, so complete information is necessary for faithful representation, right? Also, we need neutrality. In other words, what? The companies that's sitting there and saying, when I choose an accounting standard, I'm going to choose the one that always makes my revenue bigger, my assets bigger, my liabilities smaller. No, I'm going to take a path. I'm going to use estimates that always make my company look more profitable. No, they're supposed to be neutral in how they account for various transactions. And there should be freedom from error. Now, look, nobody can guarantee freedom from error, but it means that we should have what? Due diligence. We should have internal controls and whatnot that will what? Try to prevent or detect errors. Nobody's infallible, but you should at least strive for freedom from error. Okay. Now, when you look at these fundamental qualitative characteristics, okay, which are relevance and reliability, there are two of them, right? And then you look, and we also have what? Faithful representation and relevance. And then we look and we have ingredients. Okay. So what I want you to do is flashcard the ingredients that are contemplated under each one of these fundamental characteristics. Flashcard those ingredients. Could be at a very high level. You don't need to put all the detail. Just flashcard the ingredients that fall under the two fundamental qualitative characteristics. Important thing to notice here, guys. Notice that the qualitative characteristics do not share any ingredients. There are no ingredients that are reported under each, right? Each one has its own unique set of ingredients. Okay. Okay, good. Now you come over, and as I had stated, we would also have what? We would also have enhancing qualitative characteristics. So let's just go ahead and flashcard at a high level what the enhancing. So we have our primary, our fundamental qualitative, and then we have some enhancing, and we have comparability, verifiability, timeliness, and understandability. Now, when we look at comparability, guys, comparability is from company to company. I mean, this is the whole reason we have accounting standards, so that I can compare Apple to Microsoft when I'm making my investment decision, right? So company to company comparability, but also period to period. Basically saying that, yeah, we should probably be pretty consistent in how we use our accounting standards from period to period. Now, that doesn't mean that a company can never change their accounting principles. They could change from, say, the completed contract method to percentage of completion that we'll study maybe tonight, maybe next time. Okay, they can do that, but when they do, they have to put bright lines of disclosure around the fact that they have made that change. Okay, and that falls under the enhancing qualitative characteristic of comparability. Verifiability, that's the audit process. I mean, that's what happens. Because we know what standards companies are supposed to follow, CPA auditors can come in behind the company and what? And verify that they prepared the financial statements correctly. Timeliness, what happens here? If you look at the SEC filing requirements for 10K report, 10Q reports, they say, hey, if you're a large accelerated filer, you got 30 days. If you're sort of a medium-sized company, you got 60 days. If you're a smaller company, we'll give you 90 days. But notice it isn't long, my pretties, right? They are sitting there and they are saying to you, we got to get that information in the hand of investors and creditors. our primary users, so that they can make their investment and credit decisions. Understandability, to be honest with you, is well, I should say, to be honest with you, but understandability, one could observe, maybe that's a better way to put it, is the notion that we have footnotes associated with financial statements, right? We just don't whiz a bunch of numbers at people and say, here, figure it out. We have a series of footnotes that go along with those financial statements that explain some of the nuances behind the numbers that we see on the financial reports to make them more understandable. Right? Okay, good. When we talk about non-business entities here, guys, and we're not going to get too far off into this now, but just so you understand, the FASB sets the accounting standards for not-for-profit entities. Okay, FASB sets those standards. That is tested on the CPA exam. It's about 5 points on the exam, and that will be Chapter 8. Okay, and as I've mentioned, when we get into chapters 9 and 10, we'll look at governmental accounting. By the way, guys, governmental accounting is heavy on the exam. So don't think that because it's at the end of the class and at the end of the chapter, okay, I'm just going to blow that material off. That is important, and we will spend some time with that. That's maybe scary to some of you that haven't had a governmental class. Don't let it scare you. I will be able to get you well in shape to get those 10 points of governmental, 10 to 15 points of governmental. In fact, I think you'll see that those points are actually a relatively easier set of points for you to get. You just have to spend the requisite time with that material. So between not-for-profit and governmental, we're talking close to 20 points on the exam, and we'll get to that Chapter 8. Okay. Okay, good. We don't need to worry too much. They don't ask about the characteristics for not-for-profit entities too much here, but let's go ahead and just take a look, guys. Full set of financial statements. If you've gotten this far, I think you know that we have a balance sheet, an income statement, a statement of cash flows, and then you could have a separate statement that we'll study later, statement of comprehensive income, and then the statement of changes in stockholders' equity. I'm expecting you know what the fundamental statements are, right? It's full set of financial statements are. Fundamental recognition criteria. Recognition criteria, and sometimes, this stuff gets a little, wonky here and a little hard to understand. But what recognition basically is saying is, should we include something in our financial reports? Should it even be in there, period? Okay, should it be there where we can go and look and see it on the balance sheet, on the income statement? Okay, that's recognition. Okay, when we deal with what? When we deal with measurement, measurement is really saying, well, how should you weigh something? You've already decided it should be on the financial reports, but how should you weigh it? How should you measure it? How should you report it? Okay, and there are different ways of measuring the value of items. So when we talk about historical cost, we typically are going to use that for what? For fixed assets, property, plant, and equipment, right? And the reason is that for those sort of items, there's so much opportunity for subjectivity that FASB says, hey, we don't want to hear what your appraiser has to say. Have you ever had an appraiser come, you go to get a loan for a piece of property, or you're going to refinance your house or something, and every time you go to a different lender, different appraiser. I'm like, can't they standardize this? Why does it have to be a different appraiser every single time? So appraisals are not the best measure. And so FASB says, hey, because of all that, we're going to use historical cost. Okay, if we're talking about, say, inventory, we would use net realizable value. Okay, hey, what can we sell it for minus any cost to dispose of that inventory? We have to pay sales commissions or something. Current market value is what we would use for stocks. So we have purchased a stock that is publicly traded. Well, at December 31st, the end of the year, the date of our financial reports, they'll ring a bell and everybody will agree as to the price of Apple stock. So for that, there is no subjectivity. So you can use current market value or fair value. Sometimes we'll use what? we'll use cash flows, future cash flows, the present value, future cash flows to determine, etc. All they're listing to us here is what? That we can use different measurement techniques for different items in our financial reports. And as we go through and study those various things, we'll call out these different measurement methods for our various items in the financial statements. Okay. Okay, good. Now you come down, and guys, I'm not going to sit here and start reading off to you information about, what are assets, what are liabilities, etc. If you've gotten this far, I think you know that, but I do want to come down and look at, and we're going to cover some of that stuff about revenues versus gains and losses. They repeat themselves in another section here that we're going to get to in a little while. But I want to come down and I want to work this first multiple choice question of the evening. And so what we do is we have these multiple choice questions that are embedded in the textbook. You will see this same multiple choice question, let's circle that, in your homework. And so sometimes students will want to review the class questions. Well, you can go through and you can type in 13088 in your software, and it'll bring you back to this multiple choice question. But we're going to work it here together. So what I do in these, in some cases, these are actual questions. You may see this same question on your exam. You may see the same question on your exam. Now, what does that mean? The exam was disclosed until 1996. Okay, what that means when they say that the exam was disclosed until 1995, starting 1996, it wasn't disclosed anymore. So when I took my exam, I walked out of the exam site with my exam booklet. There it is. I took the May 1987 exam, and then later on I found this somewhere and I bought it. Okay, but this is the exam I took. It was disclosed. I walked out with it. I knew what answers I had given for each question because I marked it in the book, and then I transferred it over to the Scantron. And then Becker would send you their sort of idea of what the answers, what they thought the answers were. And you could then, of course, go and immediately grab your test book and at least see how you did on the multiple choice questions. So I knew going in with the multiple choice questions on the FAR exam, I would think I was scoring around 90% on those multiple choice questions. I ended up getting an 84 on FAR, which means what? I fell down a little bit on the task, what were equivalent to the task-based simulations then, but I protected myself by what? Doing well on those multiple choice questions, right? By getting 90% on those, okay? So that was how it was done. So some of the questions that were on those exams that were released, the public saw those. Becker has them in the software for you to work here. And those questions have never been released by the AICPA. So they're still in the question bank. And you may see an exact question on your exam. Now, starting in 1996, the exam was no longer disclosed. But from time to time, what FASB, what the AICPA would do, they're the one that writes the exam, they would release example questions. Some of those are in your software because we know that they're still asking questions of this nature. And so you won't see that same exact question anymore. Once it's been released, it'll no longer be on the exam again, but you may see something very, very similar. Then there's a third set of questions that you see in your homework, which is questions that Becker created that they think would be good examples of how the examiners would test some areas where they've added them to the area to the exam, but there's never been any questions released on it or not enough questions released on it to give you enough batting practice with it. And so Becker has written some questions, maybe by analogy, by looking at other questions that have been released, or maybe they've just written the questions through their team, okay? So you've got three groups of questions. So it's important that you work those questions, you get very comfortable with that, because that's going to be illustrative of what you're going to see on the exam. And I have had students that come and say, in my dreams, because students aren't supposed to tell me what's on their exam. In my dream, students will come in and tell me, dude, I had that same exact question that you talked about. It came up on my exam. Okay, so you need to practice some material. We start here tonight in class. Don't worry, if you don't get it right, it's okay. Let's say you get half the questions right here tonight. What does that mean? That means you're 50%. Well, you only need a 75 to pass the exam. You're 2/3 of the way there. Okay, then when you work the questions again, you'll get what? You'll get a 75 when you're working them, okay, when you do them again in your homework. And then by the time you're to the exam, you're going to be doing what? You're going to be working those questions at 90%. That 90% on the multiple choice question is going to give you a nice cushion as you go through and get the low-hanging fruit on the task-based simulations. And I'll talk more about task-based simulation testing strategy as we move along. Okay. All right. So with all that, I'm saying that to encourage you to do the poll, guys. You're going to see that I get a little irritated when people don't attempt the poll. So I'm going to give you 2 minutes to try this question. Okay. Everyone should try it. You begin your practice with this stuff. Your journey towards getting a 75 on the exam starts now with this first question. Okay. So go ahead and do your best with this one. So I have to launch it. And my mouse likes to play hide and seek with me. There it is. Not my mouse, but my cursor. I can find the mouse. I can't always find the cursor. Okay, guys, I'm going to go ahead and put up the answer. So why don't you make your best choice right now? Okay. And I'm ending the poll. And I always get the one person that comes in with a random choice at the end that kind of messes up our percentage a little bit. And I'm always thinking, just read the question. Don't just choose an answer just to choose an answer, because I gave you almost 2 minutes on this question. This was not a 2-minute question. The correct answer is not a question that should take you 2 minutes, and I'll say more about that in a minute. The answer is B, which 83% of us got correct. Now, the answer that came in sort of at the last second there, somebody just picked C. And I can't understand why anyone would pick C, because we observed that during the discussion, that neither of the fundamental characteristics share the same ingredients. Okay, so relevance, faithful representation are the fundamental characteristics, and none of them share the same ingredients. So C can't possibly be the right answer. So you could eliminate C right off the gate, right? Now, I told my little story about about completeness and somebody not telling you the whole story and kind of just giving you a piece of it, they weren't being what, very faithful in their representation, right? So faithful representation, completeness was an ingredient of that. Relevance was what? Was predictive value, confirmatory value, and timeliness, right? Okay. Question. Okay, now this question, I gave you about 2 minutes to answer this question. Okay, and I typically do when we're doing the questions together. Sometimes I'll give you 3 minutes. Okay, but let me talk about time a little bit. A question like this on the CPA exam should take you 10 seconds. This is a 10-second question, maybe 15-second question, where you're looking, boom, I got this because I've made the flashcard as to the ingredients of the qualitative characteristics. I got this. This should take you 10 seconds. Okay, now on the exam, moving through the multiple choice questions, we talked about timing last time. You need to be working these multiple choice questions about 1.5 minutes average per question. So if you work a question in 10 seconds, now you have a cushion of time that you can apply to the more difficult calculating type questions, right? However, you should never spend more than 3 minutes with any one multiple choice question on the exam. Now that's John's rule. The exam won't say. The exam will let you spend the whole 4 hours on the first multiple choice question, right? Okay. I'm telling you that you start spending more than 3 minutes with the multiple choice question, you're spending too much time. And it is time to narrow it down to a couple of choices and move on. Okay, remember, the exam has pre-test questions. That means that of the multiple choice questions that you have, of the 66 multiple choice questions that you have, there are about 10 that are not graded. They are pre-test questions. They're not graded. So think about it. You're spending all this time trying to answer this multiple choice question. Meanwhile, it may be one that's not even being graded. Okay, so you have to move on after about 3 minutes from any one multiple choice question. Okay, so when you're working your homework, okay, 3 minutes per question is fine. Don't worry so much about speed right now. But I'm thinking, even when you're doing your homework, you start getting into a little over 3 minutes. It's time to, even when you're doing your homework, kind of be aware of that 3 minute mark and maybe start hitting the solution and looking to see what you should have done with that question so that you don't spend too much time getting through your homework. Remember, I've said it's about 4 hours per week outside of class working your homework. But if you're sitting there and spending 20 minutes with every question, you're going to blow up that 4 hours pretty quickly too. So, you need to probably get used to starting to move on after about 3 minutes of a question. On the exam, never go over 3 minutes. Some questions can be answered in 10 seconds, 15 seconds, like this one. Question on timing? Okay. Good. So with that, let's go ahead and jump to our next module now, which is going to be looking at the income statement. Okay. Now, when we look at the income statement, we really are looking not so much as a revenue expense recognition issues as we are what is the form and content. Okay. We're already accepting that something should be on the income statement, but how should the information be arrayed? What should be the form of the income statement? And particularly becomes important when we start talking about the multiple step income statement that we're going to get to in a second. Now, remember, I kind of went past some terms there, revenue and expenses, because I said, hey, they'll come back here in a second. And so let's just take a look. And we say that revenue and expenses are reported gross, okay? And so we report those at their gross amount, the revenue and expenses, because we report our revenue gross, and then we'll start subtracting out our expenses in the calculation of net income. So we report our revenues and expenses, and we report them what? We report them at their gross amounts, okay? And you can put down here that these are operating items They're considered operating items. It says operating items. They are considered operating items in the normal course of business. Okay. Our revenue and expenses are considered operating items, and they are considered in the normal course of business, and they were reported what? They're reported at their gross amounts. Okay. Now, let's just use an example. Let's say we're talking about Nordstrom. Okay. So you go to Nordstrom, and Nordstrom sells clothes primarily, right? They sell clothes, they sell shoes, they sell shirts. So when they sell a shirt, they sell a pair of shoes. That's what? That's an operating item because that's their normal course of business, right? Expenses that they incur in the normal course of business might be the salesperson's salary, money they spend on training, right? There's a lot of training that sales people at Nordstrom get because their reputation is that they'll charge you a little more for a pair of shoes because you could probably wear it for 3 months and then bring it back, right? And they train the salespeople how to take those shoes, those nasty shoes back with a smile, right? Okay, so what happens? All of those would be expenses incurred in the normal course of business, right? The training, the salaries, that sort of thing. The sales from the shoes and stuff would be considered a normal course of business. Now you take a look at the net concept, and we talk about gains and losses, and we say that they are what? They are not in the ordinary course of business, and they are reported what? They are reported net. Where's my net? They are reported at their net amounts. Okay, so what does that mean? Okay, let's say Nordstrom decide that they're going to move from, when I was a kid, they had these mechanic cash registers where they literally went and it actually rung stuff up. I always wanted to be a cashier because it was so cool, because the person had to know how to use the thing, they had to look and see what they should type in, right? Now what happens? Now they sit there and they go, did you see who won Bachelor last night? Buddy? And they just sit there and they scan the thing, right? So what happens? Let's say Nordstrom was going to move to a new technology. They sell all their cash registers. Well, is it in the normal course of business for Nordstrom to sell cash registers? No. When you come up, they don't say, oh, sir, those are a beautiful pair of shoes. Would you like a cash register to go along with that? No, they don't do that. That's something that they may do. They may sell their cash registers. They take them all and they sell them to a cash register dealer. Okay, but the cash register dealer charges them a commission to take it off their hands. So what Nordstrom would do is they would report that, and let's say they sold it for more than book value, they would report that gain. They would report that gain if they sell it for more than book value, net of whatever commission they had to pay the cash register dealer, right? Okay. Now, I don't know if you saw in Walnut Creek, there was a Nordstrom there, and I guess some of these smash and grab people came in and smashed up the windows or something. Okay. Is Nordstrom in the business of getting their windows smashed up? No, they are not in that business. So what happens? They would have a loss for any merchandise they lost in that situation, for the smashing of the window, for the repairs, right? They'd have to pay those costs. But what happens? Let's say they have an insurance recovery on some of that. So they would report that loss, because it's not the normal course of business, and they would report that loss net of any insurance recovery. Okay. That's basically where we're going with this. Okay. Now, what I want you to do is I want you to go ahead and, oh, by the way, I should also probably put here that gains and losses are by definition considered non-operating. Okay, they are considered non-operating by definition. Gains and losses by definition are non-operating items, okay, because it's not in the normal course of business, okay? So what I want you to do is right here, co-op some of this space, and I'm going to dictate a flashcard to you. I'm not going to write out the flashcard here. You're just going to listen and write down what I'm saying. Remember when you were in the second grade and the teacher made you do dictation and you said, why is she making me do this? she was preparing you for this day, for today, for May 17th, 2022. Okay, that's what she was preparing you for. Okay, so here we go. Ready? Write this down. Compare revenue and expenses to gains and losses. Compare revenue and expenses to gains and losses. Compare revenue and expenses to gains and losses. That's on the blank side of the card. On the lined side of the card, the answer side of the card, the answer to that would be revenue and expenses are incurred in the normal course of business, are operating items, and are reported gross. Revenue and expenses are operating items, normal course of business, and reported gross. Everybody got that? Revenue and expenses are operating items, normal course of business, and reported gross. You could say on the income statement if you need to, but I think we know revenue and expenses are on the income statement. But got that? Okay. Gains and losses, the contrast, gains and losses are non-operating items, not in the normal course of business, and reported net. Gains and losses are non-operating items, not ordinary course of business, and reported net. Everybody got that? Okay, now what's the takeaway from that? Obviously, you have this flashcard now that you should make, but the takeaway is, guys, I obviously can't always sit here and dictate a flashcard to you, but the concept and what I'm trying to get you to kind of feel here now is you write a question that will elicit then what? The key elements that we want you to know to be able to answer questions on the CPA exam, right? So quick answer, quick question, quick answer. And what you're doing is you're training your brain to pull out the key concepts that are relevant, the key points that are relevant to any particular concept that you will need to know to answer the exam, right? Okay. I won't always dictate flashcards to you, but when I say, hey, make a flashcard, that's the kind of thing I'm expecting you to be able to pull out. Okay, good. Now, as I said, we're going to talk about the multiple step income statement, okay? And then later we will also look at something called the single step income statement, okay? And in the multiple step income statement, operating revenues and expenses are reported separately from non-operating items such as gains and losses, okay? Now, what I want you to put down here is what are, this could be a flashcard, what are the three main sections of the multiple step income statement? What are the three main sections of the multiple step income statement? One, there's an operating section. Two, there's a non-operating section. And three is tax. Okay, so we have operating, we have non-operating, and then we have tax. Okay, Now, the way they presented this information, I find a little irritating because they sit here and they want you to take these elements and turn them into a multiple step income statement. And I don't think we need to do that here. Right now, what I want you to do is come and look at the solution, okay? And let's see if we can find the 3 sections, even though they don't call them out as such here. I'm going to go ahead and mark this thing up and show you the 3 sections. So we have net sales, okay, and that comes down, and there's different expenses and whatnot there. And then we have income from operations, okay? So this is what? This is operating. 3 sections, operating. Let me write that. Operating. Right? So we have that. This is normal course of business. Okay. Then you come down and you have what? You have interest, gains and losses on fixed asset sales, right? Like when Nordstrom sells their cash registers, whatever. Okay, loss on available for sale securities, all the way down to income before income tax. These are what? Non-operating. They're not the normal course of business. Not normal course of bus. And then finally, I guess I need another color here. Okay. We come down here and we have what? We have very small here are what? Our tax. Okay, now you can see here that they brought in some things from discontinued operations and whatnot, but we will basically deal with that a little bit later. So if you have a situation where you have a discontinued operation, you would report that separately, but we'll deal with that later. Okay, the primary 3 sections, okay, is going to be what? Operating items, non-operating items, and then our tax, okay? And that is what will then constitute the calculation of net income. I don't know why they insisted on putting these discontinued operation things here, because we have a discontinued operations section coming later, so don't worry about that now. Okay, now you come over and let's look at some of these things. So you have your net sales, you have your what? Your cost of sales. That gives me my gross margin, gross profit. I've also seen that called. Okay. Then we have our selling expenses, for example, sales persons, salary, right? Advertising. All right. General and administrative expenses are what? Things like the CEO salary. CEO salary, accounting is a general and administrative expense. Okay. So be careful, guys, because sometimes companies will put all on one line selling general and administrative expenses. You've seen that. They are not the same. They're different in their nature, okay? And then you come down and you start to look at some of these non-operating items. Now, interest revenue is what is non-operating, say if you're a manufacturer, because you really shouldn't be borrowing to operate, right? Okay, but you may borrow from time to time, right? So interest revenue, interest expense. We've already talked about gains and losses on fixed assets, okay? If you are a bank, well, now interest revenue, interest expense would probably be what? Up in the operating section because it's a normal course of business. Now, the exam tends to focus on retail entities, not so much things like banks or specialized or The FAR part of the exam tends to focus more on retail entities. Manufacturing entities are covered more in the BEC section when we start talking about managerial cost accounting, okay? And then you have your tax, okay? Now, what I'm going to suggest you do is shrink for a flashcard. Take this thing the way we've marked it up here and shrink it down to flashcard size and have it with you. You ever see some of the, fashion people and stuff, the models, they always have like a little puppy dog, little teacup puppy dog that they carry around with them everywhere. Well, you can have like a little flashcard that you carry around with you, and you can, oh, look at this, my little pet flashcard. You just kind of take it out every now and then and show it to people, okay? Carry this thing around with you and look at it just prior to going into your exam so that you can sit there and remember the nature as to how the multiple step income statement is laid out. Now, when we come down, notice we had what? We had net income here of $25, okay? Now, if you go over to the next page and you start talking about the single step income statement, okay? And when we look at the single step income statement, the first thing to notice is that the net income is what? $25. Net income doesn't change just because a company goes from a multiple step to the single step, okay? With the single step, what do? Notice we take all of these things, revenues and other items, sales, gains, revenues, all of these things do what? They increase net income. And then we take all of these things, right? Our cost of goods sold, right? Our selling and administrative expenses, our losses, all these things that reduce net income, we group them into one big group in the calculation of what? Of our net income. So net income doesn't change, but we what? Sort of change the way we're displaying the information. Sometimes you'll see a single step income statement included like in the MD&A or parts of the annual report where they just want to quickly lay out some highlights of facts or something, and they would do that. For the most part, what we're going to see and what we're going to use is multiple step income statements, what you see when the company displays their financial reports. Now, as I've mentioned, the balance sheet will be looked at, okay, in later chapters. Really, we're looking at the balance sheet in chapters 3 through 8. So I don't know why they got silly here and had to call out the balance sheet other than to remind you that there is one, because they figured we talked too much about the income statement, I guess. Okay. All right, let's just go ahead then and let's take a look at a couple of multiple choice questions. And as I said, I'll give you about 2 minutes for this first one. We're going to look at both of these. Okay, guys, I'm going to go ahead and end the poll, and we're kind of all over the place on this one. So let's go ahead and let's talk about this, because I'm not sure what failure to communicate we ran into here. So let's take a look at the question first. Scott Corporation sold a fixed asset used for operations for greater than its carrying amount. Okay, so we're going to have a gain. So where should we report that gain on the income statement? Now, when you look at this, we have three choices. We can report it as what? As operating. We can report it as non-operating. And then the tax is just the tax, isn't it? The tax is the third section. Okay, so should it be operating or non-operating?
Non-operating.
This is non-operating because they're selling equipment used in the business, right? Selling equipment used in your business is not an operating item. When you go to Nordstrom, they don't try to sell you the building, do they? Their primary course of business is what? Selling you shirts and shoes and pants and stuff, right? Okay. Okay, good. So when you look at this, A cannot be correct because we know that what? Non-operating items for our flashcard are reported net, aren't they? So A is out. Is that what we said on the flashcard? Okay. So then you start looking, you say, okay, well, it's either B, C, or D. Net concept showing the total amount as a component of other comprehensive income. Show me where we talked about other comprehensive income being reported on the income statement. Have we talked about other comprehensive income being reported on the income statement?
No.
No. So B is not right because there was nowhere where we talked about other comprehensive income even, let alone being at one of the major primary sections of the income statement. So then we get to C, net concept showing the total gain is part of discontinued operations, net of income tax. No. I said we're not going to worry about discontinued operations at this time. Discontinued operation is when I close down an entire segment of my company, which is not what was contemplated here. This was just saying, hey, they sold a piece of equipment. And even if you were still a little confused, well, I did see discontinued operations on there. Note to Becker, don't put that on there because you're confusing us at this stage. Wait till we get to that discussion. Just don't throw something on a display and then give a lecture on it later. But that would be the conversation between me and Becker. But I told you to disregard that at this point. And it is not net of tax for sure. We know that because what? The tax is its own separate section, isn't it? We had the operating, we had the non-operating, where we showed the gains and losses on the sale of equipment, like when Nordstrom sells their cash registers, we would show that net of any commissions we had to pay to the cash register dealer or whatever, but that would be shown net. And then we had the tax, right? And the calculation of net income, okay? So D, we know by my X's up here, has to be the correct answer, net concept showing the total gain. Yeah, it's a gain because they sold it for more than its carrying value as part of continuing operations. Yeah, it was what? It was income from continuing operations. And then they had that old discontinued operation thing that was in the way. But gains and losses are part of continuing operations. They're just non-operating. And it is shown what? It is showing not net of tax because the tax is its own separate section, right? Question? Okay, good. Again, I think you're seeing how putting those things on the flashcard, understanding those flashcards, and then you apply those concepts to the multiple choice questions is the way we're going to kind of navigate through a question, which gives you all those words kind of swimming at you. Okay, all right, good. Let's take a look at this question, then we're going to take our break. Okay, guys, I'm gonna go ahead and end the poll. We're coming up on 2 minutes here, and I'm not quite sure what's going on. Are you guys following along with the discussion here? You know, when we went through and I kind of marked up the okay, we're gonna have one of those little occurrences here where if I tap the can you guys hear me? Can you hear me?
Yes. Yes.
All right. When we sometimes when I tap the chord, it sends the whole thing kablooey, which is ridiculous. But anyway, when we look at this here, let me stop sharing because this thing's in the way. Sorry, I got thrown off by that. Okay. When we look at this now, they say which should be included in general and administrative expenses. So let me ask you a couple of questions. Is general and administrative operating or non-operating?
Operating.
Operating.
Okay, that's operating. Is interest operating or non?
Non-operating.
Interest is non-operating, so A is out and B is out, right? Okay.
Yes.
Is advertising a general and administrative expense?
No, it's a selling expense.
It's a selling expense, so C is out, so D is quickly the right answer, isn't it? Okay, so a question like this should take about 10 seconds, 15 seconds. And how does it take 10, 15 seconds? Because you got that flashcard that I asked you to make, that little pet income statement. You're carrying it around with you everywhere and looking at it and petting it and playing with it all the time. Okay. Okay, good. Let's go ahead then and take the break right now. I'm showing about 6:40, give or take. So we'll come back, guys, at 6:50 and see if we can get ourselves at least through module 3 here, okay? Okay, guys, we're going to go ahead and jump back in. And generally, I would have paused the recording. I forgot to do that this time. So when you watch this back, you don't have to obviously sit there for 10, 15 minutes waiting for us to come back. You can always fast forward that past the break. And typically, I'll pause it so you don't have to do that. I forgot to do that this time. But let's jump in. And I'm thinking we'll probably get through module 3 and then end things there, because I can't finish module 4. And when I can't finish a module and I get halfway through a module, then you can't do all the homework for that module. And then we talked about some of the stuff in that module last time and you forget some of that. So I think we're better off, we'll just knock out module 3 here and call it an evening. Okay, and that'll probably take us pretty close to 8 o'clock anyway. So let's just go ahead and take a look at part 1 of revenue recognition. And there's no real distinction between the parts, other than Becker trying to make the modules a little more bite-sized for you. Okay, but remember we said that part 1 and part 2 together, revenue recognition, are going to constitute about 10 points on the exam. So it is a heavy area. Okay. Now, when we talk about the 5-step approach, and this was really talked about in Accounting Standards Codification, Section 606. You probably dealt with this in your intermediate accounting. You took it here at Golden Gate. 100A, I think, is where they talk about this accounting standard that came out, I'm going to say about 4 years ago or so, 3 or 4 years ago. And it really, what it did was codify a lot of things that several other standards had already talked about on a case-by-case type basis, and tried to say, well, if you look at those different standards that talk about how to account for contracts and these different things, you could crystallize the key elements of those into 5 steps. Okay, so a lot of what's described here are things that you're probably used to from just studying, say, how to account for construction contracts or something, how to deal with unearned revenue, et cetera, that you maybe learned some of that in your introductory to accounting class. And all we're doing now is formalizing that process into these 5 steps. Now, I don't think that on the exam, you're going to have to sit here and apply these 5 steps to be able to answer a question. But I do want you to flashcard the 5 steps in case they ask you what are the 5 steps. So I don't think you need to apply them on a step-by-step basis to be able to answer questions, but I want you to flashcard the 5 steps in case somebody asks you directly, what are the 5 steps to revenue recognition? Now, let's just go through these. And we talked about step 1 being to identify the contract with the customer. Well, look, we talk about what constitutes a contract in regulation when you get to the law section of regulation. I think starting about chapter 5 of the regulation class, we start talking about, what are the requirements of a contract. So we're not going to get into that here. Okay. Then what we need to consider are what are the performance obligations in the contract. So when you look at a contract, it could be just one performance obligation. I am to deliver to you a piece of equipment. That's just one performance obligation. There could be what? Multiple performance obligations in a contract. Well, I'm going to deliver you the equipment, but then I'm going to also sell to you a maintenance program associated with that particular equipment. Well, that would be 2 separate service obligations. And when we look at these, they could be recognized at a single point in time or over time. Okay. Now, we will determine the transaction price, and that's basically whatever the contract price is. But if you have more than one performance obligation in the contract, then you're going to have to allocate that transaction price amongst those performance obligations. And that's really what we do in step 4. And then, of course, we will recognize revenue as the entity satisfies each of the performance obligations. And again, in a single contract, you could have more than one performance obligation, and you could have a performance obligation that is delivered at one single point in time, or what? Or maybe you have something that is going to be recognized over time. Okay, so flashcard these steps. Okay, and we're going to go through and we're going to be giving you a series of examples here. And I think what you're going to see after you look at these examples, even though this sounds like a very rigid stepped process that they're talking to us here, you're going to see that there's a lot of common sense associated with what we need to do depending on our basically reading comprehension of what they're describing to us. Okay, now if the criteria for revenue recognition are not met, okay, then we will have what? We will basically have an unearned revenue, okay? And so you come over to this example and they tell us that on March 1st, Bulldog entered in a contract to transfer product to Kitty on September 1st, year one. Kitty will pay the full contract at $15,000 on August 1st, and then they will transfer the product on September 1st, and the cost of the product they tell us is $9,000, which is not really significant for the revenue recognition. But notice that on March 1st, we entered to a contract, but there is no entry to be made because nothing has been done at this point. We haven't received any cash. We haven't delivered any products, right? Okay. Now, on August 1st, when Kitty pays Bulldog, I guess Kitty's the one that's paying, right? Because we haven't performed the contract yet, but we have received some cash. And you've known this for a long time, and this is introductory to accounting. You have to debit cash, you have to credit unearned revenue at August 1st. Then on September 1st, when you finally deliver the product, now you can do what? Now you can recognize the revenue, you have performed on that contract. And, you know, the point of the cost of goods sold is not so much a revenue recognition consideration as it is just reminding you, don't forget to take the cost of goods sold and credit the inventory. Okay. So when you look at this notion that you're sitting here and you have this liability, okay, if you receive some sort of resource inflow and, you know, you haven't performed on the contract yet, one of the questions I always tell my students to ask themselves, is there a chance that you'd have to give this money back? When you get this money, is there a chance that you'd have to give it back? And if there is, you have a liability. That's the definition of the liability, is a future, probable future sacrifice of an asset. So having to give money back is future sacrifice of an asset, so you have a liability. If Bulldog took this money and told Kitty, hey, you know, too bad I'm not giving you this product, whatever it is, what would Kitty do? Kitty gives Bulldog cash. I mean, this is nothing to think deeply about. You give somebody cash to do some work for you, and then the person says, I ain't doing the work. What would you do?
I want my money back.
What would you do if they said, no, I ain't giving it to you?
Sue them?
Huh?
Sue them?
Yeah, you take them to Judge Judy and say, you know, hey, have you ever seen one of those cases on Judge Judy? She says, well, you're giving this person their money back today because you didn't perform on the contract, right? Okay. Okay, good. Now you come over, and so that's why we have to book that as a liability, because that potential that if for whatever reason we don't perform on the contract, we're in breach, we got to give that money back. Okay, that's a liability. Okay, good. Now step two, what are the performance obligations? It's going to be one or more. There's going to be one performance obligation, or there could be more than one performance obligation. Okay, so let's just take a look at what they say here. And they say that a performance obligation is a promise to transfer goods or service. I think we know that. Okay, and the transfer can be either an individual good or service, or a bundle of goods and services that is distinct, or a series of goods and services that are substantially the same, thereby transferred in the same manner. And if the promise to transfer a good or service is not distinct from other goods or services, they will be combined into a single performance obligation. Okay, so it's one or the other. It's either a single or it is going to be more than one. And if you can't separate them, it's considered a single performance obligation. Now, let's just look at an example here that I think is somewhat helpful. I don't know that's the best example in the world, but it's somewhat helpful. So let's just take a look at this example versus example 2 versus example 3. Single performance versus separately identifiable, multiple performance obligations. So let's just take a look. And Tanner Company is building a multi-unit residential complex. The entity enters into a contract with a customer for a specific unit that is under construction. The goods and services to be provided in the contract include procurement, construction, piping, wiring, installation of the equipment, and finishing. Okay, and identify the performance obligations. How many do we have here? And we have one, because you can't really do walk away with the wiring. Okay, you can't say, well, the wiring is a separate performance obligation. It's all going to be for this entire unit. It's all going to come together. So although the goods and services provided by the contractor are capable of being distinct, it is not a distinct contract because the goods and services cannot be separately identified from the promise of the construction unit. It all comes together. And so this will be accounted for as a single performance obligation. Okay, now that is different than this obvious one, not obvious, but this alternative situation where we have a software developer enters into a contract with the customer to transfer software license, perform installation, and provide software updates and tech support for 5 years. Now, what I find interesting about this one is they have the software license, the installation, updates, and tech support. And notice, guys, that the software license and the installation are probably a single point in time, okay? But the tech support is over 5 years. So notice you got two things going on here. You got separable performance obligations. You have some of the performance obligations being at a single point in time, and one of them, the tech support being over time. So you got a couple of concepts overlaying in this question, okay, or this example. So the developer sells the license, installation, updates, and tech support separately. The entity determines that each good or service is separately identifiable because the installation does not modify the software and the software's functions without the updates and the technical support. And so they have in the solution, the software is delivered before the installation, updates, and tech support, and is functional without the updates and tech support, so the customer can benefit from each good or service on its own. So we have 4 here. We have the installation, the license, the installation, the software, and the tech support. Okay. Now, where this becomes relevant or important from an accounting standpoint is we're going to have to do what? We're going to have to allocate whatever the transaction price is here now in step 3 amongst those. If it's one performance obligation, it's easy, right? The whole amount goes to the one. But if we have several performance obligations, we'll have to allocate them amongst those different performance obligations. So when you take a look at the transaction price, okay, I turned my page too soon. Okay, I didn't have anything I want to highlight there. So let's just take a look. And there are various types of as the way the consideration can come in. So there could be variable consideration. With variable consideration, this is the amount that's going to be paid, should be estimated by taking a range of possible amounts and using the expected value, okay, or the most likely amount, okay? So why don't you go ahead and flashcard that, okay? It's variable consideration, but just to sort of make up a quick example here, they'll say, well, the price will be this if this happens, but it will be that if that happens, and it'll be this amount if that happens. So what you would do is you would assign a probability to each one of those variables, and then you would come up with an expected value for the overall contract. And then once you have that, then again, if it was a one single performance, you'd allocate the entire estimated amount, expected value to that one performance obligation, or you could then have to allocate it amongst the more than one performance obligation. If there is significant financing, okay, you have to use the time value of money, okay, to adjust the transaction price. So let's just go ahead and point down right now. Let's just look at this right now. This example down here, okay, we'll come back up to the other two here in a minute. But on January 1st, year 5, SDF sold furniture to customers for $4,000 with 3 years interest-free credit, okay? In the United States, there is no such thing as interest-free. There's no such thing as interest-free, okay? The customer, we're gonna have to use the time value of money. The customer took delivery of the furniture on that day. The $4,000 is payable to SDF on December 31st, year 7. The applicable discount rate is 8%, okay? And so what they did was they said, well, okay, if that's the case, then I have to multiply the $4,000 by the factor that is associated with that interest rate. Now, what you would do is go to the present value of a dollar table here, and you would go to the 3-year row, and you'd go to the 8% column, and in there is a factor 0.79383 is the way I like to think about this, okay? And then you would go ahead and you would take that and multiply that by what? By 4,000, and that's where they got that 3,175. Okay, but you have to consider present value, and then the difference between the amount you actually collect and what that 3,175 needs to be recognized as interest revenue to the seller, interest expense to the buyer. And so there'd be this 3,175 times the 8%, and then that is going to compound over the next 3 years. So only the 3,175, and think back to our discussion of the income statement. It's important because what? We would show a revenue of 3,175, but we'd be showing what? Interest revenue accruing each year in the non-operating section, you know, as shown here for years 5, 6, and 7. Okay, so you've got to consider that time value of money. Okay, now you come over, and so when I say flashcard, once you flashcard the 3 variables here, the 3 factors that would affect the price, the variable consideration, the significant financing, non-cash consideration would be based on the fair value of the non-cash items. If it's equipment for equipment, let's say, then we're going to have to look to the fair value of whatever we're giving up in order to determine what the fair value of the item is that we're receiving. And then consideration of a payable, a consideration that is given to the customer, such as coupons and whatnot, would be a reduction of the transaction price. Okay, so you can flashcard the 4 of these as just a high level in considering the contract price. I think the most important one here, remembering that we use what? Time value of money if we're going to be receiving consideration over time. And this variable consideration one, I don't think the examiners get too much into this, but basically they'd be telling you, well, there's a 10% chance the revenue will be this much, a 50% chance the revenue will be that much, 40% chance it will be that much. You just apply the percentage, the probabilities to each one of those amounts, add them together to come up with the expected value. Okay. All right, good. Come over and let's take a look at the allocation, okay, which is probably the more interesting part of this and probably something that I think you can expect to see on the exam. I could see them expecting you to know how to allocate a contract price where there are multiple performance obligations. Okay, so let's just take a look. And I think this is a very good example here of how I could see them giving you a set of facts, maybe even in a task-based simulation, and expecting you to be able to, allocate the price to the various performance obligations. Okay, so the approach that we're talking about here is where they're able to take those performance obligations and they're able to treat them as though they were standalone products. If you do that, now you've got what? A basis for allocating whatever the contract price is for those different performance obligations. And again, you could recognize them at a point in time, or you could recognize them over time, which this brings in all of those elements. So I think this is a pretty good little example. So let's just take a look at it. We have this software company entered into a contract for $250,000. We've identified the contract. We've identified the price. Piece of cake, right? Okay, now we just have to say, well, do we have single performance obligation, multiple performance obligations, and how will we allocate this price to if it's multiple performance obligations, and are they going to be recognized at a point in time or over time? That's the questions you're asking, right? Okay, so for the customer to transfer software, they entered a contract to transfer the software license, perform installation, provide tech support for a 3-year period. The entity sells the license, installation service, and tech support separately. Major clue, hello, we have what? Multiple performance obligations, right? The installation service and tech support could be performed by other entities, and the software remains functional in the absences of these services. Again, giving us more information, multiple performance obligations here. The contract price must be paid on installation of the software, which is planned for March 1st. Okay, so how should the software company recognize? The entity has 3 performance obligations: the license, the installation, the tech support. Okay, now this is kind of the really takeaway from this, because we kind of knew all this from looking at the very similar example from earlier. The standalone selling prices can be determined for each performance obligation. The license is usually sold for $160. The installation is sold for $20,000, and the tech support is sold for $30,000 per year, guys. And when I was looking at this earlier, I was like, I couldn't get this 270, and the reason I couldn't get the 270, which is the denominator here in this allocation scheme, is because I forgot to say, well, if it's 30,000 times what? Times 3 years gives us what? Gives us the 90,000. That was kind of panicking a little bit earlier. Where they come up with the 90,000? Oh, 3 years, right? Because I didn't read the question carefully. Okay, so that's where that 90,000 comes from. 160 plus 20 plus 90 gives us 270, and then we take this contract price, which the question generous, just laid out there for us, is 250, and we multiply it, and that's how much we allocate to each performance obligation. Okay. Now, though, we have to say, well, should we recognize this at a point in time or over time? And the answer is what? For the licenses, we take those amounts, right? Boom, boom, trying to draw them down to the next page, but we're taking those amounts down and we're taking them immediately at the point in time when we receive the cash, because all we had to do was provide the software and install it. And then we have what? A liability and unearned service revenue, because we haven't provided the tech support yet. That's going to be what? Over the next 3 years. So we take that 83,333 and we divide it by what? By the 36 months. And I guess in this first, they had to make this a little more interesting for us here, because the CPA exam does like to do this for us. For the first year, it'd be what? March, April, May, June, July, August, September, October, November, December, 10 months. I count on my fingers to make sure I've got the months, because otherwise I mess up. I'd say, oh, well, 3 months, there's 12 months in a year. The third month is March, so that's 9 months. I do that all the time. So count on your fingers. Make sure you know how many months are involved. So for that first year, it's going to be what? It's going to be the $2,314 and 80 cents, which is the amount per month times the 10 months. And then the remaining of the years, it'd be all 12 months. And I guess for that fourth year, it'd just be what, 3 months, right? Of the fourth year. Okay. 12 months in a year. Okay. Question. Okay, good. Now let's take a look at when we will recognize revenue when the entity satisfies a performance obligation, okay? And it could be satisfied over time, or what? Or a single point in time. And we've really already looked at this in that previous example, okay? But we're just going to really look at criteria here, okay? Single point in time, guys, is going to be at 2.5.3. Okay, here at 2.5.2, satisfied over time. So what would cause us to recognize a revenue over time? So let's just flashcard these criteria for recognizing the revenue over time. And notice, guys, it's what? When any one of these criteria are met. When you see something like that, they're saying, here's the criteria, and if any one is met, that's when you do X, Y, or Z. That's the same way saying flashcard this, because I can see a question coming where they're going to ask you, they're going to describe a situation to you and ask you, should you recognize this over time, or when we get to 2.5.3 at a single point in time. Okay, so revenue is recognized over time when the entity performs or creates or enhances an asset that the customer controls. Good example there would be, let's say somebody's doing some work in my backyard. So they're doing some landscaping and stuff in my backyard. Do I control the product as they develop it? Yeah, so they would probably recognize revenue as they do some initial work, say, you know, they flatten out the yard or whatever they're going to do, prepare to lay some, you know, patio or something. So they flatten out the yard, and I'm looking at my yard as I'm thinking about this. They flatten out the yard, right? Well, they maybe will bill me for that part, and they can take that revenue because what? They have done that part of it, and I'm controlling that asset, right? Okay, they can't take my backyard from me. Okay, the customer receives and consumes benefits for the entity's performance as the entity performs, such as cleaning service. So you take the revenue as you perform the cleaning service in the contract. Hey, I have a contract with you to come clean my office building once a week or something. Well, when you perform that week, you could take the revenue for that. Or the entity performs performance does not create an asset with alternative uses, okay, and the entity has an enforceable right to receive payments. So what happens? Well, now, and this really is, we'll get into some specific applications next time, but let's say you're building a yacht for me, and the deal is that you can't turn around and sell that yacht to somebody else. It's my yacht, okay? You got to sell it to me. Well, now you can take what? Now you can take the revenue as you build that, maybe using some sort of, you know, inputs that you are putting into the construction of that as you incur certain costs, okay? So notice, in order to recognize revenue, the entity must be reasonably, be able to reasonably measure progress towards completion. And when we do that, it's going to be what? We're going to look at output versus input. So you take a look, output, okay, by using output methods, revenue is recognized based on the value to the customer of the goods or service transferred to the date the services are promised. Okay, so again, you've given me so much, you've delivered so much product to me, you can take that much revenue. Input methods, again, is sort of what we look at when we look at percentage of completion. As you spend money in constructing that, that's an input, and you can take revenue based on how much of the total inputs you have put in at that point in time. Okay, so those are the criteria for that you saw on the previous page for when you will recognize at a overtime. And often you can just use straight line for that, guys. Okay, and so in this example, they use straight line. As they perform a year's worth of contract over time, they take that monthly. Okay, satisfied over time. That's straight line. I think you know that. Okay, now satisfied at a point in time. Okay, and let's just take a look. If it's not satisfied over time, it's satisfied at a point in time, and revenue should be recognized at a point of time when the customer obtained control of the asset. Okay, so let's just see what control would constitute, and let's flashcard that. Okay, the entity has the right to payment, and the customer has an obligation to pay for the asset. The customer has a legal title to the asset. The entity has transferred physical possession of the asset. You think? I mean, once the customer's got it, right? The customer has the significant rewards and risks of ownership, and the customer has accepted the asset. So just think of it this way. Think of buying a new car. You buy a new car and they give you the keys and you're driving the car off the lot and you hit a pole. Who suffers the loss? What does the car dealer say to you? You hit a pole, not their pole, let's say. You hit a pole. You hit a pole somewhere.
Tough luck.
They say, look what happened to your car. Okay, that's a sale for them because they've given you possession. You have the legal title to the asset, or at least, you know, the lender has legal title to it at that point in time, et cetera, right? Okay, okay, good. Now let's just take a look at this example here where the performance can be satisfied over time versus a point in time. Okay, and remember, we're keeping those criteria in the back of our mind here. Okay, so Tanner Company is building a multi-unit residential complex. The entity enters into a contract with a customer for a specific unit that is under construction. The contract has the following terms. Okay, now I have a little problem because it's kind of hard when it's a multi-unit residential complex visualizing this. So I like the example, but let's just get away from a multiple unit residential complex and let's just talk about a custom home. Okay, let's say they're building you a custom home. You have contracted somebody, you have the land, whatever, and you have now hired somebody to come in and build this home for you. Okay, and so what happens? Let's say you have the following terms. You pay a non-refundable security deposit upon entering the contract. The customer agrees to make progressive payments during construction. I mean, that's going to be the case. The builder is going to expect you to be giving them money as they go along, as they buy this, as they buy that, right? If the customer fails to make the progressive payment, the entity has the right to all of the consideration if they complete the unit. So you don't make it, but they build a house for you. And maybe the contractor would do that to say, well, screw this, I'm not getting this, but I'm going to force this guy to pay me something to buy this house from me, right? Now they're going to take you to court and force you to pay them in this situation, right? And the terms of the contract prevent the entity from directing the unit to another customer. So it's not like if you don't pay them, they have the ability to sell that house to somebody else. It's your land, right? I mean, how's that going to work, right? So under that situation, then you would recognize that revenue over time because you can say, well, we've earned this much because we laid the foundation and that was 10% of our total cost. So we can take 10% of the contract price as revenue. Okay. So it's satisfied over time. and it doesn't have alternative uses. It cannot be directed to another customer, and the entity has the right for payment if they go ahead and complete the unit. Okay, now performance obligation satisfied at a point in time. Now I'm thinking more a tract home. So what's happening? When it's a tract home, the builder owns the land, they own the house. You got to come and ask them, is it okay? And you say, is it okay if I look at my house? And it ain't your house. It's still what? Their house. And they could do what? They can sell it to somebody else if you don't come up with the money, right, to pay that to them. And you may have to give a deposit, but if you don't buy the house, then you lose the deposit. But in the state of California, the law is that if they sell the house for as much or more than the contract price, they got to give you your deposit back. Okay, and they do that to protect consumers, because sometimes consumers run into trouble. You know, hey, I lost my job, I can't buy the house now. You know, and so to protect consumers, state of California, I'm sure probably other states provide protections. Well, now the seller, the developer will just turn around and say, hey, guess what, Martha, you're number 20 on the waiting list, and the house, the person couldn't buy it, so you get it now at this price. Well, then they have to return the deposit to that person. That's California law. Okay, but let's just take a look. Again, they did a multi-residential, I'm thinking a tract home, whatever, but the customer pays a deposit upon entering the contract that is refundable if the entity fails to complete the unit, or again, I'm saying in California, if they can sell it to somebody else, they got to give it back to you. Okay, then what? The remainder of the purchase price is due on completion of the unit, right? You give them the deposit, and then no money changes hands until the day that what? The property becomes yours. Okay, that's what happens when you buy a home from a developer. It's not yours until what? Everybody gets their money, right? Okay, if the customer defaults on the contract before completion, the entity only has the right to retain the deposit. Again, unless in the state of California, they may have to give the deposit back if they sell it for that much. So what happens? Determine whether the performance obligation is satisfied over time or at a point in time. This would be what? At a point in time. When they give you the keys, okay, they go and you cut that little ribbon or whatever it is they do, if you do, that's when they can recognize the revenue. Okay. All right, good. That's why I think it's kind of funny the way they're doing new homes now. They're sitting there and they're only releasing so many of the homes at a time, where you can come in and get a deposit and get a particular lot and particular home, and then they start to build it and stuff. And I kind of laugh because they're doing that now because the demand is so high for homes, right? Keep telling people, if the demand for homes starts to turn back the other way, okay, those developers are stuck with those parcels of land that they have, and they got to pay the property taxes on those. They own that land. They're gonna have to pay the property tax, and at some point in time, their investors are gonna say, get going. Get those damn things off of the books, sell those damn houses, because there's money going out in property taxes and whatnot, and interest if they borrowed money and they're not selling them. And so I think if the market turns back the other way, they might start being a little bit motivated to sell those properties a little faster, as opposed to having this big waiting list and all this kind of stuff at a time when the demand, they know they're going to be able to sell those houses because demand is so high for them and the price is going up, right? Okay, good. So let's just take a look, which is not relevant to what we're talking about, just a crazy thought I had. So let's just take a look at how we will present on the financial statements these different contract, either asset, or it could be a contract liability on our, and we're calling it statement of financial position, which is a fancy way for obviously saying in balance sheet, since we're talking about assets and liabilities. Okay, now you take a look and we say a contract asset reflects the entity's right to consideration in exchange for goods or services that the entity has transferred to the customer. Essentially, the entity has performed prior to the customer paying or prior to the payment. And so we have this conditions associated with the right are something other than the passage of time. Okay, so let's just look at that. And I want you to put in here C example number 9. And I guess that's next page. So I just want to go to that right now, because then they start getting into the liability, and then they give you an example of a liability. Meanwhile, they didn't give us an example of the asset until the next page. So let's just go there now. Okay, so let's just take a look at a contract asset. Okay, and on January 1st, Anderson Company enters into a contract with Tanner for the sale of 2 excavators at $350,000 each. An excavator is a thing that digs a hole in the ground for a construction company, whatever, right? Okay, the contract requires 1 excavator to be delivered on February 1st and states that the payment of the delivery for the first excavator is conditional on the delivery of the second excavator, and the second one comes on June 1st. Okay, so what happens? Nothing happens on January 1st, but on February 1st, they recognize a contract asset because they delivered the first excavator. So they can take the revenue, okay, but they don't have any cash coming in yet. They can't debit cash. They can't debit receivable because receivable is reserved for the situation where it is simply what? The passage of time. We're just waiting for them to pay us. Okay, that's not the situation. Here, we haven't received anything yet because it's predicated on what? On us delivering that second excavator, but we can take the revenue because we performed on the first one, right? Okay, then what? Then we go to June 1st, okay, and on June 1st, what happens? Well, they deliver the second excavator, okay, and so they take the revenue for the second excavator. They credit the contract asset now because they've performed on the entire contract, and because they're waiting for payment now, they can go ahead and take a receivable because it is simply the passage of time. And they don't tell us when they were supposed to pay this, do they? Do they say when they were supposed to receive payment? I don't see any discussion as to when they were supposed to receive payment. But let's say they received payment, I don't know, 6:30. I'm just making that up. They didn't say that. Then obviously, they would do what? Debit cash for the 700,000 and credit the receivable, right? For the 700,000. It's a receivable because now we're just waiting. And I just made up that 6:30 part. Now they're just waiting for the payment. Okay. Okay, good. So now come back up because we're going to look at the liability here in a second, contract liability. But note here what we just saw there. If the payment date is conditional only by the passage of time, then we can book the receivable, right? So when we were just waiting for the payment, when it was conditional on the delivery of the second excavator, it was a contract asset. We were just waiting for the payment after we performed everything we needed to on the contract, then it was receivable. Okay. Okay, good. Contract liability must be booked when an entity has an obligation to transfer goods or services to a customer. In this situation, the entity has already received consideration from the customer, or the customer owes consideration and it is unconditional. Okay, so the customer pays or owes payment before we perform. Okay, so what happens here? On January 1st, Anderson Company enters into a non-cancelable contract with Tanner for the sale of an excavator of $350,000. The excavator will be delivered on April 1st, but the contract requires Tanner to pay in advance on February 1st. and they make the payment finally on March 1st. Now, I don't know why they waited until March to pay, but they did. And the only reason they did that is to show that what? On February 1st, you can book the receivable because you're now having the right to receive something. But because you haven't performed the contract yet, you have what? A contract liability. Then, for whatever reason, they didn't pay them until March. Okay, fine. When they finally pay them, you debit the cash, you credit the receivable. And then, of course, when you finally what? Deliver the, whatever it was, is it excavator again? Whatever this thing was, you have the excavator, then you performed on the contract, you could take the revenue. Okay, so, you know, not a big deal here on the contract liability. I mean, it's kind of a fancy word of saying unearned revenue. The only thing was for that one is what? How do you distinguish between a, you know, when do you book a receivable for that? And you book a receivable when it's due and they haven't paid you yet. And then when they pay you, you simply liquidate that receivable. But this contract liability is a fancy word for saying what? Unearned revenue. They paid you in advance, right? Okay. Okay, good. And then we looked at the contract asset example already. So with all that, let's take a look at this question. Number one, I think you can see this is a pretty easy question, but go ahead and let you work on it. Okay, guys, I'm going to go ahead and end the poll because it looks like almost everybody got this done and got it 100% correct, right? And again, they're providing a monthly service here, aren't they? Okay, so when the customer pays the $540 in advance, we would debit cash, right? $540. Credit what? Credit unearned revenue or contract liability, whatever. Okay, I guess there's really no contract liability because it's not like we've, you know, well, I guess it could be contract liability. I don't know. Unearned revenue versus contract liability to me seemed like just two different sides of the same coin. Okay, and then we go ahead and we take what? We take the 540, we divide that by 12. That means they're earning what? $45 a month as they provide the service. So each month they would debit the unearned for $45 a month. And each month they would do that. Debit the unearned, 45, credit the revenue, right? Okay, pretty simple. Everybody got that right. Okay, good. Now this last question that we look at tonight, and then we're gonna call it an evening. I'm gonna go through with you, okay? And this is the reason I'm doing this one with you as opposed to turning you loose on it, because when you look at questions like this and they ask you, well, what would be a debit? What would be a credit? Okay, and only one of these is correct in the journal entries that will be made for this transaction. Okay, is this how you were trained? Were you trained to just think about credit and debit when you look at a transaction, or were you trained to what? Understand the transaction and make a journal entry?
Yes.
Huh? That's
Yes.
right. You were trained to look at a description of a transaction, make a journal entry, and that's your training, isn't it? So when they describe a transaction to you and then the question's asking you for a piece of the journal entry, don't fall into that trap. Make the whole journal entry and then compare your journal entries to the answers and see what you get. See which one's the right answer. Okay, so let's just look at this. On April 15th, year 3, Land and Company signed a contract that entailed providing a piece of scientific equipment for $215,000 to Jacob Labs, with delivery expected to occur on August 31st, year 3. Per the terms of the contract, Jacobs will pay Landon for the full amount on July 31st, year 3. Landon's cost to produce the equipment is $175,000, assuming delivery occurs as expected on August 31st. On the August 31st journal entry for Landon will involve the following. Now, you need to look at this and say, well, wait a minute. There is a July 31st transaction, isn't there? Okay, in which what? In which I always forget who's who. Okay, so we're doing the accounting for Landon. Okay, so Landon, right, will get some cash, won't they? On July 31st, per the terms of the contract. So they're going to debit cash, $215,000. Credit what? Contract liability.
Yes.
I know that's going to happen on July 1st. And then, which is what the question asked, on August 31st, what's going to happen? Well, they're going to go ahead and they're going to deliver the product, and they did deliver it as expected. Okay, so on 8/31, now they can take that revenue, can't they?
Yes.
So they'll debit contract liability, $215,000, and they'll credit what? Revenue, $215,000, but they're also going to, at this point, do what? Deliver the item, whatever it is, aren't they? So they will have to debit cost of goods sold for the cost of the item, $117,000, and credit the inventory. Right, because they would have booked that to finished goods inventory as they produced it, whatever. So now they credit inventory, debit cost of goods sold. So now that I have journalized this whole thing, I'm looking and I'm saying, okay, well, what happened at August 31st? And the answer is going to be come from one of these lines right here. Is there a credit to cash on August 31st? Is there a credit to cash anywhere in this transaction? Okay. Is there a debit to inventory on August 31st? No, I would do what? Credit inventory as I'm delivering the product, right? Okay. Is there a credit to cost of goods sold? Give me a break. Come on now. Why would I credit cost of goods sold unless the stuff was being returned to me? And there's no discussion of a thing being returned. Yeah, there's a debit to the unearned sales revenue or contract liability. Like I said, there are two sides of the same coin, guys. Okay. But here now, we would debit the unearned sales revenue, contract liability. Unearned revenue is a liability. Okay. Question about anything? Okay, guys, we're gonna go ahead and call that an evening then. I don't want to start to get into module 4 because I do, but we can't finish it. And then we pick up in the middle of a module, but you forget things that were in the beginning of the module when you go to do your homework next week, and it creates a whole thing. So we'll save that one, put this 10 minutes in our back pocket and save it for next time. And we will jump into module 4. Okay. Any question? All right, guys, have a good rest of the evening. Have a good rest of the week. You should be doing the homework for the first 3 modules, and I'm going to be checking. Okay.
Have a good night.
Okay.
Thank you.
Bye-bye, guys.
Thank you.
Thank you. Have a good night.
Good night.